Hi, everyone. Welcome back to another session, Strategic Financial Management. So today I will be diving into the topic, Strategic Financial Management. So what do you know about Strategic Financial Management? Let's break it down. Let's break this word or let's break this phrase into a couple of words. We have Strategic Financial Management. Strategic financial management. So what is strategic financial management? Does anyone know? Any volunteers? What is strategy? What is finance? What is management? So I don't want you to give the entire or the meaning of the entire word strategic financial management. Give me at least the meaning of one word, maybe strategy, maybe finance, maybe management. Anyone? No? I've said this many times. I want this class to be interactive. Yeah, so when I ask you questions, it's better if you can answer me. Anyone who's willing to answer the question? No? Zahara, how about you? What is strategy? What is finance? What is management? Okay, what is management? What is the meaning of the word management? What does a manager do? Okay, let's put it that way. What does a manager do?
Planning, directing, and
Yes, what is it?
yeah,
Could you-
it's the planning, directing, organizing,
Mhm.
remote control. Yeah.
Yeah, you can say yes. So one of the key roles and responsibilities, or few of the key roles and responsibilities of a manager is planning, organizing, leading, controlling, and decision making. Now we're moving on to strategic financial management. Let's see what is strategic financial management. Now, all organizations, they require financial management for its successful operation, right? Every organization should manage its finances effectively in order to attain its mission and goals. Not just organization, you and I, yeah, individuals. We too have to manage our finance effectively. Yeah. So when we receive our salary or when we receive an income, we have to organize it. Okay, this is what we're going to do. This is our income. These are expenses. This is how we're going to spend our money. And this is how much we're going to save. So if we spend the money the way we want, what's going to happen? At the end of the month, it's difficult. Yeah. So even organizations, they need to control, they need to manage, they need to know these are my inflows, these are my outflows, these are my income, these are my expenses. How do I manage it? How do I control it? That is what we're going to learn in strategic financial management. Now, strategic financial management, this refers to the study of finance with a long-term perspective. That is the reason the word strategy, this focuses on long-term perspectives. Long-term perspectives. And then we have finance. What is finance? Related to money. And then we have management. What is management or managing? Planning, organizing, leading, controlling, everything. So then we have the word strategic financial management, which means this is management approach which makes use of various financial tools and techniques in order to come up with a strategic or long-term decision plan. According to SIMA, it says the identification of the possible strategies capable of maximizing an organization's NPV, net present value. You'll be learning in detail when we do investment appraisal methods towards the end of the module. The allocation of scarce capital or resources between competing opportunities and the implementation and monitoring of the chosen strategy so as to achieve stated objectives. So this is the definition for strategic financial management. This is the definition that is given by SIMA. Let's move on. So when it comes to strategic financial management, right? Strategic financial management, they have two main decisions: the financing decisions and the investment decision. The finance decision and the investment decision. What is finance decision? Finance decision external. Why do I call it external? Why does it have to be external? External is because this is where we are going to acquire the funds. We're going to acquire funds, financing decision, especially or specifically focusing on the capital structure. Capital structure, yeah, whether it's debt or equity. Are we going to be raising money by borrowing, like issuing bonds or making or taking bank loans? Or is the owner, or will the owner invest money into the business? So is it debt financing or equity financing? So this is where we make the decision, okay, what type of finance, what is the source of finance? Financing decision. And then we're moving on to investment decision. What is investment decision? Now, this is also known as capital budgeting decisions. This refers to the process of evaluating and selecting long-term investment projects. And this is where we calculate or we use different techniques under investment appraisal method known as NPV, net present value, IRR, payback period, which you'll be learning towards the end of the module. So in here, in the investment decision, we are planning, we are deciding what type of investment are we going to make. Are we purchasing a new machinery? Are we launching a new product? Are we expanding our business? Or maybe expanding our business into a different market. So maybe we're locally doing the business as of now, but maybe we're planning to expand the business internationally. Investment decisions. As you can see here, we have the finance decision, equity, debt, or government aid, acquisition of funds, and then disposition of funds, meaning what are we going to do with the money? Are we going to invest in an asset? Are we going to invest in a project? Yeah, this is investment decision. So these are the two main decisions that is coming under SFM, strategic finance management. Now let's look into the importance of strategic finance management or strategic financial management. Why is it important? Number one, it helps in detecting the requirements of capital in the business. It helps in detecting the requirements of the capital in business. Now, the foremost function or the primary function of financial management is that they estimate, they forecast the money or the amount needed for the smooth functioning of the business. So here they will, through SFM, through strategic financial management, the organization will be able to find out, okay, this is the amount of money that we need. So helps in detecting the requirement of capital in the business. Number two, helps in deciding the composition of the capital structure. Once the capital requirement of the business are calculated, the next function that needs to be completed by the financial manager is deciding what type of capital structure does the business need. Now, we spoke about this before, meaning the source of finance. What are the source of finance, right? Is it equity or is it debt? And then comes the third, helps in choosing the right source of finance. So this step simply aims at choosing the most appropriate. Now you have so many choices. When it comes to short-term finances, long-term finances, there's so many choices. Now you need to choose the right one. Now, just because you have so many options doesn't mean that you can select everything. Yeah, because each type of finance, each of these finances, they have their, pros and cons. What are the types of finances that is available? Let's talk about short-term finance. What are the finance options that we have for short term? Can you give me some examples? A few examples. No? The ones who are in the accounting background, they should be knowing. Mm? So there are two types of finance, short-term finances and long-term finances. Like short-term finances are the funds that is needed for immediate needs of the organization. So typically within a year or maybe less. So these are the finances that the business organization requires. Okay, they require it within a year or less than a year. So some of the options are trade credit, overdrafts, factoring. You call it debt factoring, where you sell your debtors to a third party and then you get the money from them and they'll be dealing with your debtors later on. So this is factoring, or you call it debt factoring. And you have overdraft, bank overdraft, meaning a bank allows the organization to spend more than its account balance. And also they have a credit limit. So this is the amount that you can use more than what is available in your account. And then again, overdraft is, there is interest added if you delay the payment. This is short term. And also we have short term loans. Then we have long-term finances. Now, long-term finances are the funds that is needed for investing in long-term assets, probably more than a year, right? Generally, more than a year. For an example, if you need to purchase a machinery that is expensive, then you need long-term finance. Yeah, you need long-term finance. So here you have long-term bonds, equity financing, where you issue shares or stock to raise funds, and also long-term loans. That comes under long-term finance. Now, allocating and investing the finance raised. So now we are going to decide, okay, we have raised the finance through various sources of finance. Now we have to make the right decision in revenue generating. How are we going to use the money that we have raised right? So which project are we going to invest? Which project is going to give you more money or more return than the other project? So here we're going to allocate and invest in the finance raised. And finally, managing cash expenses. So this simply means management of the cash. So the expense is within the budget. For an example, you should be able to earn income. Your income should be more than your expense. Yeah, your income should be more than your expense. What happens if it's the other way around? What happens if the income or the expense is more than your income? When the expense is more than your income, right? When the expense is more than your income, that is when you have to rely on external or other sources of finance. Other sources of finance. So when you're able to manage your expenses, right? When you're able to manage your expenses, again, you'll have a question. How do we manage the expenses? There are certain expenses that we can't cut. So you have to find out what are the expenses that is not required for the business. Maybe there are certain expenses that is not really necessary. So you can curtail it, right? You can curtail it. Now, for an example, I can also take this example. Imagine you're working or there is a production department and there are 10 steps. Okay, there are 10 steps that you have to follow in order to produce a product. So 10 steps, 1, 2, 3, 4, 10, then you get the product. So when you carefully analyze, you will find out that some of the steps, right? Some of the steps can be done by one person. Can be done by one person. So imagine these 10 steps are done by 10 people, 10 employees. So after carefully analyzing, right? After carefully analyzing and going through this entire process, you realize, okay, there are certain steps that's quite simple, and this can be done by actually one person. So now what do? You start merging the steps. So now you found out, okay, now it's no more 10 steps. You only need 7 steps to follow in order to produce the product. Now, what do you do here? Initially, you needed, or the organization required, the production department required 10 people to produce the product. Now you only need 7 people. What does that mean? You're cutting down your expenses. So this is how businesses find out which area or where there are loopholes, right? Where can you curtail the expenses? Where can you manage your expenses? So here they are specifically speaking about cash expenses. Now cash payments, yes. Now cash payments, this is also something that the business has to focus. Now cash payments, you require, or the business requires to pay salaries and wages to the employees. So controlling, it is one of the most important function in order to run the operational activities of the business smoothly. And through strategic financial management, all these will be easy. All these will be easy. Let's move to the next one. Now let's see, what is financial planning? What do you mean by financial planning? Financial planning, one of the financial planning's largest member and advocate groups, yes, Financial Planning Association, they define financial planning as the long-term process of wisely managing your finances so you can achieve your goals and dreams. It makes sense, isn't it? The long-term process of wisely managing your finances so you can achieve your goals and dreams. If you're able to manage your finances effectively, you will be able to create a roadmap to reach your goals. Yeah. So if you're earning a salary, or if you say for an example, you have invested your money to a project, or you invested your money in the stock market, and this is the return that you get. Yeah. So you can sort of calculate your savings and plan your future. So maybe in 10 years' time, you can say, I'm going to build a mansion. Or in 10 years' time, I'm going to purchase an expensive car. So all these can be done through financial planning. So financial planning involves forecasting, right? Forecasting future financial needs and ensuring that you take the necessary steps to follow it. Importance of financial planning. Why is financial planning important? Number one, to identify the cash inflow and outflow of the business. Attrill, in one of his book, Financial Management, he describes cash as the lifeblood of a business. Lifeblood of a business. You need cash. You know, to run your day-to-day operations, you need cash. Just imagine, say for an example, a person, right, an individual has plenty of assets, has houses, has cars, has all types of assets, but no cash in hand. No debit, no credit card, nothing. No cash in hand. It's difficult to run his life smoothly, isn't it? Although you have assets, if you don't have cash, it's difficult. Same with the businesses. Organizations need cash. They need cash inflow in order to look into the outflow of the business. So if you need to run the organizational operational activities smoothly, you need an effective cash inflow and outflow system. So it is vital for a business to have sufficient liquid resources. You call this liquid resources. Yeah, liquid resources to meet its obligations, as failure to do so is going to hinder the smooth flow of the operational activities in the business. So financial planning, this helps the managers and the company to prepare a projected cash flow statement. So here they will be looking into the spending patterns of the company. So you can also look into the history, the past spending pattern, and forecast the future spending pattern. So this is our cash inflow. This is the cash outflow. This is how we're going to plan it. So how do they do it? Via financial planning. So through an effective financial plan, the managers will be able to increase the cash flow of the business by controlling the expense of the business. Poor cash management will lead to unexpected loss and low productivity. So you need to make sure that you have a structured financial plan that provides various pathways to increase, or I would say, to control the cash expenses of the business. Number two, to make effective financing and investing decisions. Now, we've discussed these 2 points here. Yeah, to make effective financing and investing decisions. Now, financing and investing decision, this plays an important role in the job of a financial manager. Now, these 2 decisions are very crucial. Now, you might think these are just 2 decisions, but no. They're crucial because one wrong decision, if the financial manager makes one wrong decision, everything is messed up. Everything is messed up. So when you have 2 options, A and B, right? You have 2 options, A and B. One project is going to give you a return or a profit. The other project is going to give you a loss. So imagine this is going to give you a profit. Project A is going to give you a profit, whereas project B, you will have to bear a loss. Now, if the finance manager does not analyze these 2 projects accurately, so the finance manager says, okay, let's go with project B. What's going to happen? The company has to bear a loss. So that is a reason when you make investing decisions, you always have to analyze which project is better. And that's the reason we do something called, or we follow a technique called investment appraisal method. Here we take data and we analyze which project is going to give you a better return, which is safe, and then you invest in that project. So this is one of the main job role of a finance manager. And through financial planning, they're able to do it effectively. Number 3, helps to make secure decision for the company. The managers of the company are accountable for every decision they make. So the decision-making task will be much easier if they have a proper plan. Yeah, if they have a proper financial plan, it will be easier for them to make decisions. So through preparing a financial plan, the managers are able to see whether the decision is aligned with the capital base of the business, whether it is aligned with the capital base of the business, whether it is aligned with the goals and objectives of the business. Are we on the right track? Yeah, are we on the right track? So when decisions that are made related to cash investments, the preparation of a financial plan is crucial. Is crucial. Number 4, analyze the risks and costs of financing. What do you mean by analyzing the risk and cost of financing? As I told you before, this particular point, analyzing the risk and cost of financing. Each type of finance, each source of finance, they have their own risks and cost of financing, right? So when a company is seeking, or when a company seeks financing, whether it is via debt or equity, it has to face risks and costs associated with each type of finance. Let's take, for an example, debt financing. What is debt financing? This involves borrowing funds, maybe from maybe from loans, maybe from individuals, and you have to pay an interest. So what are the risks? Repayment obligation. When it comes to bank loan, it comes with a fixed interest rate. So you have to pay the interest. If you don't, what's going to happen? If you don't, it's going to cause a big problem. Yeah, because when you take bank loans, you have to take it against something. Yeah. And then the cost of debt financing, you have interest payments, issuance cost. And then again, when it comes to equity financing, I'm particularly referring to financing through shares, financing through selling shares. So when you issue shares, the shareholders, specifically the ordinary shareholders, they have the right to vote in the decision making of the business. Right? So when the shareholders gets more control, right? When the shareholders gets more control, they may have more voting power that influences the decision making and the direction of the company. So these are some of the risks and costs of finance. Next, to forecast future sales. To forecast future sales. The financial plan of the business will help the managers to determine the sales of the business at present and also to forecast the future sales. So usually when you do forecast, you look into the past sales and then you will be adjusting certain things and then you will forecast the future sales. Again, this can only be done through a financial plan. And number 6, which is very important, control or avoid unnecessary expenditures, not just organization. Now, this is a good example for all of us. Yeah, controlling or avoiding unnecessary expenditure. You know, some of the expenses, we don't really need it, but we do it. So same with organization. So if you need to have or if you need to reach a certain goal or an objective in your life, right? You need to be very careful with your finances. So the managers are able to forecast the future expense of the business when preparing the financial plan. So they will be looking into when they're preparing the financial plan, they will be listing their income. These are our potential income. These are our future income. These are our expenses. These are our expenses. So via a financial planning, it will assist the managers to control and curtail the unnecessary expenses of the business. So the managers can decide, okay, what are the most important expenses, right? So what is the best spending pattern or what is the best saving pattern? How are we able to save more money in the business? So this can be done while you prepare the financial plan. So these are some of the importance of financial planning. Yes, there are more. There are more importances of financial planning. Same with strategic financial management, but I'm just discussing the most important ones here. And now we're moving on to the topic financial control. What do you mean by financial control? What do you mean by financial control? This class is very quiet. Who can tell me? What is finance? What is control? And then you merge the two words and then it becomes financial control. So what is financial control? What is finance? Money. What is control? Managing and monitoring. Yeah, so what is financial control then? The process of managing and monitoring a company's financial resources to make sure that the organization is aligned or aligning with the goals and objectives of the business. This is financial control, right? So strategic planning and control is the process of deciding an objective of the organization. So I did not introduce you to the three elements of financial control. Okay, financial control is basically divided into three sections: strategic planning and control, tactical or management control, and finally, the operational control. Now, what is strategic planning and control? Strategic planning and control, this is the process of deciding on objectives of the organization So strategic planning and control is the process of deciding on objectives of the organizations, the changes in these objectives, and the resources that is used to attain these objectives. So as you can see, it's a comprehensive process. It's a comprehensive process of determining an organization's objectives, revising them if it is necessary. Now, sometimes you might write down the goals and objectives of the business. But as time passes, when the external environment changes, when the economy changes, when the technology changes, when there's advancement in technology, when there are, certain changes in the economy, maybe an economic downturn, maybe there's inflation, then the organizational objectives needs to be amended. So say for an example, the economy is not doing well. Okay, say for an example, the organization decided, okay, we need to increase our sales from 20% to 50% this year in 2024. Just an example. Just imagine this is their objective, right? 20% to 50% in the year 2024. So just imagine we're in the beginning of 2024. And while we move to the month of May, right? April, May, then what happens? The organization realized, okay, the economy is not doing well. The goods and services are expensive in the market. That means the customers' spending patterns are going to change. When the customer spending patterns are going to change, they will not have enough money. So when the products and services, when the goods and services are expensive, the customers will spend money on the most essential items. So they will not have enough savings to spend on other products. So initially this was their objective. But when they realize that the economy is not doing well, they will have to what? Amend or revise the goals and objectives as necessary. Get it? Next, identifying the resources required to achieve them. So when you have a goal and objective, you need resources to achieve them. And establishing policies that regulate the acquisition, utilization, and disposal of said resources. Okay. Now let's say you have a career goal, right? You have a career goal. Everybody has goals in life. So I'm just taking an example of career goal. So say for an example, you need to be the chief financial officer in your company, CFO, right? That's your plan. You need to become the CFO of your company. Now, this is your goal, right? This is your goal. So how do you reach it? You need qualifications. You need experience. You need a good network. Yeah. So you should be book smart plus street smart. Yeah. Just having a qualification, just having the book knowledge is not enough. You also need to know what is happening around the world related to finance. What is happening with the banking sectors? What is happening with fintech? Yeah, finance technology. What is happening? How is it affecting the business? You need to know everything. So you need to identify the resources. What are the resources that you require to achieve them? You need your qualification. You need to be street smart and book smart. You need to talk to people. You need to gain knowledge talking to people. So everything, identifying the resources. Only then you will be able to reach the position of a CFO. Just an example, okay, maybe you need to be a marketing manager, an HR manager, maybe a head of the department. So any goals that you have, you need to identify, what do I need to do if I need to reach this goal? List it down. It's easier. And you have to remember now, this is a strategic plan. It's a long-term perspective. You can't be a head of the department, when you're at the beginner, maybe you're a junior HR, so you can't be at the head of the department overnight. That's not going to happen unless somebody influences. But generally it's not going to happen. So you need to work for it. So you have to list it down. Okay, these are the things that I need to do if I need to achieve this goal. It's going to take time. It might take time. You have to be patient. So if there's any goals, objectives, vision, mission, anything in your life, right? You need to work for it every single day. And you should never, ever give up. You'll feel like giving up, but you should not give up. Same with organizations. All these massive or multinational organizations, all these organizations that are successful right now, it did not happen within a day or two. They worked towards it. Yeah, like Apple company, how it started. Apple company, Microsoft, how it started. You know how it started. Yeah, they started with nothing, to be honest. And look where they are right now. Yeah, look where they are right now. So they took a long time to achieve their goals and objectives. So same with you. And now moving on to the next one, tactical or management control. Now, this is the process by which managers assure that resources are obtained and used effectively and efficiently in the business. So tactical or management control, here you are, or the manager, they are going to make sure that the available resources, that the resources are scarce. What is scarce? Scarcity. I think this is like the first thing, or the first word or the concept that you learn under economics. Yeah, the basic problem of limited resources. This is the first thing that you're going to learn if you're into economics. So scarcity, economics starts with scarcity. That's a fundamental concept that is taught in economics, which means the basic problem. What is a basic problem? Limited resources. So how are we going to use these resources efficiently and effectively? The 4 factors of production: land, labor, capital, entrepreneurship. How are we going to use it effectively to produce goods and services? So the manager will have to see how to use this effectively. Less input, more output. More input, less output, there's some problem. You get me? So it should be this way. Input equals output. So less input, more output. Less input, more output. What if it's the opposite? More input, less output? Something is very wrong with the company. Okay, then you can say, oh, the company is not productive, right? There should be some waste happening. Maybe there's no quality management. So the manager has to make sure that they give less input, more output, meaning that the available resources are effectively and efficiently used by the business. So here you have so many practices that the businesses follow. They follow something called TQM. You might learn it under operational management. No, I don't think you have operational management. Yeah, TQM is coming under operational management, maybe under strategic management. Yeah, you might learn TQM. Anyways, I'm just going to give you a brief description on TQM. So TQM, total quality management. Now, this is the process, or this is a wide approach, meaning it focuses on continuous improvement. There's another word for continuous improvement, which is a Japanese word, which is kaizen, right? Continuous improvement, meaning they actively involve all employees from top to bottom, right? All employees at all levels will be focusing on improving the quality of the product. This is total quality management, right? So tactical or management control comes under this. And finally, we have operational control. Operational control this is the process of assuring that specific tasks are carried out effectively and efficiently in the business. I've been using this word a lot, effectively and efficiently in the business. So this is financial control. So financial control is divided into 3, or there are 3 sections, 3 concepts under financial control: strategic planning and control, tactical and management control, and operational control. Now we're moving on to business environment. Business environment. Business environment, under this, we're going to learn about sole proprietorship, partnership, corporations, and limited liability companies. And I'm sure that you're aware of these terms, but anyways, I'm just going to give you a brief description on everything. So sole proprietorship, I call this the one man show, meaning, sole proprietorship business is owned by a single person, run by a single person, profit is earned by the single person, or loss is bared by a single person. Everything is done by just one person. So sole proprietorship is one of the oldest form of business organization. As the title suggests, it is run or owned by one person. So he holds the title to all of the assets and personally responsible for all of its debts. Right? And remember, a proprietor, a sole proprietor, does not pay a separate income tax. Right? And this is about sole proprietorship. Next, we have partnership. So sole proprietorship is like a single person. So this is your life while you're a single person. And then you decide, okay, your business is run alone and you feel so lonely. You feel like, okay, now it's the time to get someone to my business. And now what happens? The single or sole proprietorship becomes partnership. A partnership is also very similar to a sole proprietorship. They have similar characteristics, just like you finding your soulmate. Yeah. So a partnership, they share similar characteristic with a proprietorship. But the main difference is that a partnership involves multiple owners. So not just one person, but two or more. Two or more. And in terms of taxation, the partnership entity does not pay income tax. Instead, each partner is individually responsible for reporting their share of the business's profits or losses as part of their taxable income. Yes, when it comes to partnership, so they will be giving, or you will be getting, a percentage of the profit from the business. So depending, when you involve in a partnership business, they will be giving you an agreement, right? You'll have to sign an agreement and you will be receiving your share of profit, depending on the investment, depending on your involvement in the business. Right? So even in partnership, there are different varieties or different categories of partnership. There's general partnership. Now here, all partners have unlimited liability, meaning they're jointly liable for the obligations of the partnership. And when you have limited partnership, which means limited partners, they contribute capital and have liability confined to that amount of capital. So this is limited and unlimited. There are two types of liability: limited liability and unlimited liability. So what is the difference between limited liability and unlimited liability? Limited liability means this refers where the financial responsibility of the owners of a business is limited to the amount they have invested in the business. So if the business is bankrupted, or in the event of a bankruptcy, right, the personal assets of the owners will not be risked. Okay? They will not be used. They're protected. Nothing is going to happen to your personal assets in limited liability. But in unlimited liability, it's the opposite. So here, the owners of a business are personally responsible for all of the business debts and obligations. So in case of a bankruptcy, if the amount of the business or within the business, the company assets are not enough to pay up the debts or to pay off the debts, then they will be using your personal assets, the owner's personal assets, to pay off the debts. This is partnership. So sole proprietorship, general partnership comes under unlimited liability structure. LLCs, limited liability companies, corporations, they come under limited liability category. Yes, these corporations and limited liability companies, they are under limited liability. So corporation, this is a legal entity that establishes a company governed by a board of directors and can issue stocks to shareholders and investors to generate capital. The formation of a corporation provides limited liability and asset protection, which is similar to that of an LLC. LLC means limited liability company. So corporation, limited liability company, they're very similar to each other. And when it comes to corporations, sorry, they will be issuing stocks to shareholders and investors to generate capital. And finally, we have limited liability company. This is also a legal business activity owned by its members. This type of structure is often preferred by small business owners as it is simple to establish and manage compared to a corporation. Right, compared to a corporation, limited liability companies to set up a limited liability company, it's far more easier than a corporation. All right, so this is about limited liability companies. So let's go through a quick revision before we wind up the session today. So I spoke about strategic financial management. So I broke it down into 3 words: strategy, finance, management. Strategy, long-term perspective; management, planning, controlling, leading, and decision making. Wait, planning, organizing, leading, and controlling. And finance means money. And then we learned, or we discussed about the finance decision, external, and the investment decision in detail. And we learned the importances of strategic financial management. We learned about financial planning. Why is it important to a business? We learned about financial controls, and then we learned about business environment. And under business environment, we learned about sole proprietorship, partnership, corporations, and limited liability companies. Thank you so much for attending the session today. I'll see you tomorrow with another session.